Hi, it's Dak Hartsock with a market view update. Today's April 30th, 2015. This whole video should be 10 or 11 minutes long. We're going to have a look at the fundamental aspects of what's happening in the market right now, and also look at what's called the tactical or technical aspects of what's happening in the market right now. And this is really designed to help people think about some of the things that professional investors are looking for, some of the things the biggest guys are aware of, and sometimes influence their decisions and give you an idea maybe how to be a little bit smarter with your money in the market. I've got some clients on here, some friends, some family, some subscribers. Every now and then these things get forwarded to somebody that doesn't know me, or who I am, what I do, or why I do it. So for that person, if you'd like to learn more about me, you can just go to dakhartsock.com. There's a short video on the About page. And then if that's interesting to you, feel free to sign up for the monthly features. Again, they're all designed to really help people better understand what's going on in the markets and be a little bit smarter with the way they handle their money. So without further ado, let's jump into what's happening in terms of the tactical view in the market right now, and we'll move on from there into fundamentals and get this thing wrapped up in 10, 11 minutes or so. So let's go ahead and have a look at the first part. Again, I'll cover fundamentals second, but this first part is kind of going to be about tacticals, and I'm going to kind of give you some things to think about that professional investors kind of look at to get a feeling for what might be happening in the market, what's going on, how they sometimes react in kind of shorter time frames than the intermediate term, the longer term. And also what this does is helps make clear what kind of trend we're in terms of how likely it may be to continue, what the boundaries of the trend have been in the past, and so on. But before I get too far into that, I want to give a little bit of backdrop and explain what we're looking at, so kind of set the table a little bit. I don't know if you can see my cursor or not. Sometimes it shows up, sometimes it doesn't, but at any rate, what we've got here are a set of red arrows, and I'm hoping you can see those. I'm kind of running the cursor over them here, but you can see they go on up all the way. And then there's a set of green arrows below them that you can see. And then down here on this lower part of the screen, you can see some red arrows. So let me give a little context as to what these things mean. Basically, when you see a red arrow, the market is starting into a corrective phase. And to give a little context, historically, 8 out of 10 years, generally, about 8 out of 10 years, you can pretty much bet on the market having 3 or 4 corrections internally. And the way that looks is you normally will get 2 or 3 kind of moderate corrections, corrections that go down, 3, 4, 5%, and you'll generally also get one correction in the area of 10%. That's when the market sells down. And what you see with these arrows is the market is beginning to enter a corrective phase. And another way you can tell that's happening is by looking at the volume, and that's what this part of the screen represents. These red lines here are selling. The green lines are buying. And generally, whenever you see either the red or the green get above this yellow line that's highlighted here, that means heavier selling or heavier buying. And to push volumes up over that yellow line, you're talking it's mutual funds, it's hedge funds, it's family offices with a few billion to throw around, it's billionaire investors that are able to move it at this level. And then what you see is, sometimes there's a lot of buying, sometimes there's a lot of selling. The market's a little bit schizophrenic, or maybe bipolar is a better way to put it. One day things are great and everybody wants to buy. Kind of the next day, sometimes the world seems like it's ending. And that's why you see a lot of this price movement up and down. Now, let's kind of go back to here for a couple of minutes and let me finish setting the table. So we've got this corrective phase beginning here back in 2011, and what we see here, these green arrows represent the meeting of the Federal Open Market Committee. So we see that occurring. And what's happened here is in 2011, as many of you know, I feel the Fed held off a bear market. They had an unscheduled meeting in August, and then again in September, they basically released a very supportive statement of the markets. And what happens? Well, up we go generally. And you can see that repeatedly. So this pretty much, Fed statements have underpinned a lot of the trend since 2009 that's been pushing the market up. And the thing to think about here is as we move out of 2012, this is also where we saw earnings actually begin to accelerate. And it's not a big surprise that, up until this point, what we've got is, the Fed really supporting the majority of the up move in the market. But now, here, we're seeing earnings begin to accelerate. And so the market is beginning to support itself a little bit, but yet the Fed still steps in. Couple more pieces of context here. This red set of bars here is what's called a regression channel. It's not that important, but what it does illustrate is the center line here is the mean of this regression channel. And the easy way to think about it is average. It's not really the same thing, but it's close enough for this illustration. And that's kind of important because you'll notice the market in general has a tendency to find its way back to the mean, or the average. Again, not the same thing, but close. So sometimes it's a little above, sometimes it's a little below, but in general, it's kind of hanging around that area. Now, these blue lines are what I drew in here. This is what's called a price channel. And what we see here is this begins when the earnings are really taking hold and the market is beginning to value on the earnings a little bit more versus just pure Fed support. And so that's kind of a smaller channel that price has kind of held in over the last couple of years, with a couple exceptions, that being a correction. But even so, you're still staying, within the big channel here, and also the uptrend here that's persisted since 2009. So what this says is the intermediate price trend really seems intact, but at the same time, if we look up over here, we're seeing a lot more choppiness. How price is moving up and down and up and down and up and down a little more than it kind of has in the past. And what this is called is a period of either consolidation or exhaustion. Now, what that can mean is that if the market is consolidating, it's just going to kind of bang around in here for a while. We might see it, sit in this kind of zone, maybe go up a little bit, down a little bit, up a little bit, down a little bit for a few months. Or if it's actual exhaustion, we could see the market begin to pull back. Now, my view is that if we're talking about equal weighted earnings in the S&P, then we've seen earnings pull back about 3% last quarter, and it's looking like they're going to pull back again this quarter. So what that means is not only are buyers and sellers kind of maybe getting a little exhausted, and particularly buyers, but it might also mean that their earnings are not quite high enough to make people feel comfortable with these valuations, which suggests a correction will come. And that's kind of my view right now. I think the trend up is intact and will probably remain that way as long as the Fed stays as dovish as they are, and I think that's going to go on for quite a while. But I think we're due a pullback at some point within the next few months because earnings are lagging, and there's also this thing called seasonality where, about 8 and 10 years, I think I mentioned this, the market has a tendency to pull back. And the Fed, I think, has just made a couple of statements back to back, within a few months of each other of support, but the market is still not able to get up over where it was. So that suggests to me that there's probably a pullback coming. If we get a normal, healthy correction, that's going to take us down. This 10% correction from most recent high is going to take us down to this green bar. And I'm using the spider, SPY, as the ticker symbol as a proxy for the S&P 500, just because it's easier to track earnings and things like that, and also easier to look at the charts and figure out what's happening. So if we get a 10% pullback, we're probably going to settle in around 192 or so on the spider, or if we're talking about the S&P 500, that would be 1910, 1920, somewhere in that zone. It might not come down that far. We might be in this area, here. I hope you can see the cursor, but about the 195, 196 area, it might come down, you know, into here, into the 185 area. But 10% is going to be right around in here, and that might represent an interesting place to think about putting some money to work, depending on, you know, what it is you're looking for in terms of multi-year returns. Now let's take a look at the fundamentals. Let me flip a slide here and we'll have a quick look at that, and then I'll wrap things up. Okay, so here we go. We're going to take a very quick look at fundamentals here and wrap this thing up. It's important to be aware of what's happening here, because these are the things that the Wall Street billionaires, the mutual fund managers, the big hedge fund guys are looking at. And specifically when it comes to the S&P, it's earnings that they're paying the most attention to. So what we have here is 10 years of quarterly earnings on the S&P, and you can clearly see where the Great Recession was. And this lower line here is the primary earnings trend since the Great Recession, and then the secondary line here is the accelerated earnings growth trend that kicked in 2012. And it's no coincidence that as earnings rose above and stayed above the point where they were in 2007 prior to the Great Recession, the market itself began to respond in terms of the price moving up and up and up. And of course you see the Fed lending some support when things kind of went a little sideways or started to come apart, and that's helped the market continue up, as we know. So what's important here, the takeaway, is that as long as the companies in the S&P can continue to produce growing earnings, especially if it grows along this trend here, the accelerated trend, then over time there's a very good probability the market will continue to move up. There's even room for it to come down a bit. As long as it stays above this primary earnings trend, the likelihood is that, you know, barring some kind of exogenous shock, that the market will continue over time to move up. No guarantees, obviously. So the other takeaway from this is, you know, you hear a lot in the media about how earnings are falling and so on and so forth, but what are they really falling? Last quarter, the Q4 of 2014, earnings fell about 3% from the prior quarter. If we assume that earnings fall another 3% this quarter, and they may fall less, they may fall more, I don't think it's going to be too much more, but you know, let's just pretend it's 3% and we'll know in a few more weeks. You can see the impact of buying, you know, at the same price, even with the lower earnings growth rate. It's not impactful at all in terms of your expected returns. You know, valuation is impactful, but again, you can go to the site if you want to read a little bit more about that. To close, just these arrows, the red arrow, the green arrow, this is just the recession probability indicator that my firm and I use. You can see it saying, you know, reduce risk here well before the crash. It's saying increase your risk here when most investors were still very timidly sitting on the sidelines. So pretty useful indicator. You can read about that on the site as well. And now I'm going to wrap it up. If anybody has any additional questions or comments, feel free to email me or maybe stop by the site and leave a comment, and I'll get back to you as soon as I can. Hope everybody got something useful out of this, and we'll do this again maybe in about a month. Thanks.